Let's do a quick check here on the major averages. Your S&P 500 up 0.7%. Your tech-heavy NASDAQ taking the majority of the gains, up nearly 1.3%. But let's double click on the S&P 500. I want to pull up a year-to-date chart because the S&P 500 is officially up on the year if it were to close at these current levels. The level that we are watching this morning is 58.81. That is the level that the S&P 500 has to close above to officially be up for the year. Right now it's at about 58.88. So we are on track to close up if we do continue these gains to the upside on the S&P 500. And as a reminder, that is a far cry from the 15% drop year to date that the S&P 500 was sitting at on April 8th after a slew of tariff-driven headwinds and headlines led to a lot of market pessimism coming in here. Now we are seeing that movement coming in back to the upside as stocks have recovered from those losses, at least at the current moment. Well, Treasury Secretary Scott Bessent was optimistic on Tuesday when discussing talks with Asian trading partners, telling reporters things are going well on the heels of a temporary truce with China. Bessent was more cautious on EU negotiations, saying talks between the U.S. and Europe may be a bit slower thanks to differing attitudes within the bloc. Comments come just one day after a China tariff pause ignited a monster rally in U.S. markets. So what might future negotiations mean for the U.S. economy? John Leer, Morning Consult Chief Economist, joining us now. John, great to speak with you this morning. I want to talk about the data that you have for us on consumer sentiment. If we can pull up the chart on that here, you'll take a look at this because you say that we are already seeing an increase to the upside in consumer sentiment off the back of negotiations, not deals. Talk me through that, because I have a hard time believing that consumers are following the tariff headlines the same way that you and I are because we're paid to. How is sentiment already recovering off the back of this news?
Well, I think there's two primary channels through which sentiment is recovering. The first is that sort of direct policy channel, right? Just some level of tariff easing. Even before the trade negotiations with China were announced, we already knew that the reciprocal tariffs were being walked back slowly but surely. So there was sort of momentum in that direction. And then the other more, I think, direct effect on consumers is through markets and public markets. So strong stock markets lead to a strong wealth effect. And we see that, in fact, when you take that number and break it out by different market segments, we see higher earners with more money invested in the stock market have more directly benefited from these trade announcements over the last couple of days.
Yes, talk to me about that. The idea that the wealthier consumer is feeling better because of market activity here. How does that impact what we would call the hard data, the actual spending patterns for that higher income group, which does make up the majority of consumer spending?
Yeah, it impacts it pretty directly, although I would say it impacts it, the word I use is asymmetrically. So we know that a rapid deterioration in sentiment tends to lead to a deterioration in spending. We see that, for example, the Chicago Fed uses our data for their nowcast of retail sales, their CARTS index, really for that real-time downturn monitoring effect. And so I think right now we're in a situation, right, where we've got sentiment recovering. We continue to see a strong labor market. Through yesterday, the data I saw showed that we had another strong week last week. And so I think all of that together paints a picture of a really strong consumer. Remember, not too long ago, pre-Liberation Day, the U.S. economy was in a great position. I think slowly but surely we're trying to get back essentially to where we were at the end of March.
And my guest host, Lou, has a question for you, John.
Hey, John, it's amazing what a difference a week makes in terms of trade talks and negotiations. It looks really constructive. But my question for you is, how do we factor in the chance that these trade talks could fall apart just as quickly as they came together? And at what point does the consumer just get fatigued and change their behavior permanently because of that? They don't know when it's going to happen. I mean, how do you calculate for that?
I mean, it's a great question. I think thus far what we've seen from consumers is some reticence to dramatically change their behaviors in response to trade negotiations, tariff negotiations, right? Because announcing a 145% tariff on Chinese-made goods is not the same as, in fact, paying 145% more the next day. Companies have ways of working around things. We also know from our small business survey that we run with the Boston Fed that small businesses were very reluctant to immediately pass on those elevated costs. They were going to do so over a period of 2+ years. So I think from the perspective of consumers, they're sitting back and they're saying, well, what does this mean for me and my pocketbook? The expectations of tariffs, I think wrongfully were over, I think people wrongfully thought tariff announcements and tariff expectations were immediately going to affect consumers' pocketbooks. That didn't happen. And so we've got some breathing room right now. and I expect consumers to go back and spend.
Yeah, so just to follow up too, in terms of the hard data versus soft data, right? If we don't know where consumers are going to lay out, how do you balance that? Ignore some of the sentiment data, and what data, hard data, would you put more priority on given this environment?
So I think right now, in a period of elevated volatility, I tend to look more at the soft data just because it's more of a real-time indicator. On top of that, with the hard data, you're going to get revisions, 3 months, 6 months, 9 months down the road. So you've got to be a little careful as it relates to sort of where you prioritize the signal as opposed to the noise. We saw very clearly in the announcement following the Liberation Day that consumers were starting to feel worse about their expectations, but their assessment of their personal finances remained pretty strong. That's what I was telling a lot of CFOs and heads of investor relations was, look, the future is really uncertain, but the present is pretty strong. And so there's an opportunity right now, to sort of adopt this, to go try to capture some of that market at the higher end of the income spectrum in particular, where folks have a little bit more room to absorb higher costs. So I think it's going to be a really sort of company by company specific outcome as it relates to the consumer. But overall, we're in a much better position now than we were a week ago.
Well, talk to me about the labor market here, because one thing that I want to hit on, we're getting some headlines that Microsoft is cutting 3% of all workers. They are not tying this to any performance-related issues. A spokesperson telling CNBC one objective here is to reduce layers of management. John, I wonder how you're thinking about how companies are responding to the macroeconomic uncertainty of this moment. I heard you saying this idea that consumers were going to have this stark negative reaction straight away was a little bit overdone. Fine, but we're already getting headlines the companies are cutting their staff. So does that economic impact start to trickle in and slow the economy?
It might. The strength thus far over the last few weeks of the U.S. economy has been the jobs market. And I think there's certainly a world out there. You could imagine a world where tariff announcements created such uncertainty that businesses immediately pulled back on hiring and started laying workers off. We didn't see that. We didn't see it in Morning Consult's own proprietary data. You didn't see it in the jobs data for April. You don't see it in the unemployment claims data. I think that's because companies deep down inside know that there's money to be made by selling in the here and now, in the present, and that it would be a significant loss of opportunity to go sort of shut things down, essentially because you expect the future to be so uncertain. Instead, what's more likely to have happened, and what we see in some of our small business data, is that businesses reduce their longer-term investment planning. They reduce some of their more speculative investments, but they continue to hire and staff in the near term, again, because there was money to be made. So it's sort of like a game of musical chairs. Nobody wants to be left without a chair, but you don't also want to be the first one to sit down unnecessarily when there's still a game to be played.